covering the month of June, the Bureau of Labor Statistics reporting that on a month-over-month basis, the index increased by 0.9%. That is relatively hot compared to what the street was expecting. The estimates were for something closer to 0.5%. But if you look at the CPI on a year-over-year basis, the index increased by 5.4%. That's the largest since August of 2008, actually tied the number that we had seen in that month. But when you do strip out the more volatile components of that index, what they call the core CPI, this strips out food and also energy, that clocked in for the month of June at 4.5% on a year-over-year basis. And this is the figure that you'd have to go back to before I was born, November of 1991, to see a print that high. Now, what was interesting was I spoke with a White House official yesterday and talking about the idea that whether or not a high print today could kind of show any sort of concerns over inflation being more persistent. The official saying something along the lines of they've been taking comfort in what we've seen, and they've been pointing to 5-year break-evens, which implies something closer to a 2.5% inflation expectation, which has essentially been unchanged since the beginning of June. So they said this report shouldn't change things. Of course, that conversation was before the print came out. But I want to walk you through some expenditure categories specifically within the CPI. Gasoline and fuel oil, we've seen prices increase between May and June. That's one reason why the headline CPI increased as much as it did. And then take a look at used cars and trucks. That increased by 10.5% between the months of May and June. That actually accounted for more than 1/3 of the seasonally adjusted figure on that headline CPI figure. So important to remember that those used cars and truck prices are unlikely to stick around. So that could be one possible factor in the transitory argument for inflation. Then lastly, shelter costs. Pay attention to this. 0.5% month over month increase, not necessarily an eye-popping number, but it's a tilt up from what we've seen in previous months. That could be something that's more persistent if people are inking 12-month, 24-month rent contracts or buying houses. That could ultimately increase prices over the longer term. So worth watching. And then one other little nugget I want to point out, women's dresses were up 5% month over month, 15.8% year over year. That could be part of the reopening trade as people get out and about. But very interesting figures in that CPI print. Again, the largest that we've seen since August of 2008 on the top line, guys.
Don't like that one. But Brian, I want to ask about the reaction that we're seeing in the Treasury market. We talked a little bit about stocks seeing a little bit of dip here. The 10-year yield up just a basis point here. So given that on the face of it, this looks like a hot print, even though as you broke it down, it does matter where that inflation is coming from. Does this again reflect the view that this is transitory? Is the bond market buying it?
Well, I think when it comes to the bond market, we have to remember that there are a number of factors that come into play. It's much like the stock market. It's really difficult to attribute any sort of movement to one specific point. But of course, yes, we did see 10-year and longer term bond yields blink in response to that report this morning. But when you consider the fact that relative to where the 10-year was, let's call it in the beginning of the spring, we're still relatively low levels. And I think that when we talk about the bond vigilantes and whether or not they were successful in their kind of early summer changing of their positioning, I think that's definitely something to be looked at. But when we look at the overall inflationary story, we cannot look just at nominal yields. That's a big reason why people are trying to look at the 5-year break evens, taking a look at where market bets are, what they call market-based expectations for inflation over a 5-year period. And again, when you look at that, it is true since the beginning of June, essentially, they've been unchanged despite the large movements that we've seen in the bond market and the volatility over the past few months. Those expectations still pretty anchored at around 2.5%. And I think if you talk to Fed officials and say, look, we might get 2.5% inflation over the next 5 years, some of them would probably say we're okay with that, which is a very different departure from the Fed before this crisis, before their framework change, where they would be a little bit more nervous about seeing prints above their 2% inflation target. Now they're willing to moderately allow that inflation figure to overshoot its target. So I think overall, we still need to look at bond yields within the context of real and nominal, although, of course, we also need to look at those inflation expectations on a survey-based basis, which we saw from the New York Fed yesterday are continuing to tilt up. So there are a number of factors at play here.
Yeah, a lot to consider. Oh, sorry. Go ahead, Miles.
No, go ahead. You got it. I'm not reading off Slack here, Julie. I only have one screen to work with this week.
It's tricky. It's tricky to follow along with everything, let alone to follow along with all these different inflation measures. I just wanted to ask about Fed speak. because we're getting some Fed speakers today. James Bullard also already out this morning talking to the Wall Street Journal saying he thinks the time is right to start to remove stimulus, although he's not in favor of a rate increase in terms of removing stimulus until late next year. We're going to hear from other Fed speakers today. We're going to hear from Jay Powell later in the week. What do you think is the message here that we're going to get from these guys?
Well, I think the Fed is going to be very careful about the way that it phrases anything with regards to specifically tapering, because when it comes to the interest rate path, we know what the Federal Reserve had signaled at the June meeting when they had that dot plot projection showing the possibility of 2 rate hikes by the end of 2023. But the first step, which people tend to forget about before raising interest rates, would be tapering its asset purchases, that pace of about $120 billion a month in U.S. Treasuries and agency mortgage-backed securities. And the Fed has said, look, it's very much likely that this tapering process could begin before the end of the year. That's the commentary that we've been hearing from Fed officials. But I think the Fed doesn't want to rock the boat before even that July FOMC meeting, probably wanting to set something up for the Jackson Hole symposium, which would be happening at the end of August. I think that's really where the Federal Reserve would like to see an announcement. That way they don't kind of rock markets before that point in time. Now, of course, the Fed speak before that could present a lot of risk. You mentioned James Bullard from the St. Louis Fed speaking this morning. There are a number of other hawkish members like the likes of Dallas Fed President Robert Kaplan that could also potentially rock the boat. So, yes, there is a number of Fed speak on the calendar this week, including 2 days of back-to-back testimony from the Fed Chairman Jerome Powell tomorrow and Thursday. But I would expect that they would probably reiterate what they said in the FOMC minutes through the June meeting, which is that, yes, those discussions are beginning, but they're going to keep their cards close to the chest over the coming months.
All right. Yahoo Finance is Brian Cheung with the latest on the inflation data. And of course, folks, you can catch Brian for 2 full hours starting here at 11 a.m. Eastern on Yahoo Finance Live. Brian, we'll see you then.